Okay, so this week what we are looking at is we started looking at some monetary policy yesterday. Interest rates, quantitative easing. We're going to go back through those just in terms of what the correct answers were, just so you can check up on that. And in terms of our development this week, it's looking at joint ventures. We'll look at a little bit of how the Bank of England has a wider role than monetary policy in terms of the stability of the financial sector and regulating banks. Then a little bit of macro revision for the end of the week, just to bring together a few topics, and a little multiple choice quiz. So just looking back at those things you did yesterday: impacts of interest rates on aggregate demand, impacts of quantitative easing, and the reasons why monetary policy might not have the intended consequences. So what we started with in the second year here was financial market rules, so the functions, market for exchange of goods and services, insurance to provide stability, markets for loaning and savings, equities and futures markets, then examples of the institutions like commercial or investment banks, insurance providers, so on. Then we looked at the financial market failures, so the ones that we brought through from year 12, like negative externalities and information failures, things like the PPI scandal. Then the new ones for A2 second year: moral hazard, things like the banks being too big to fail and being bailed out, asset bubbles, and market dominance or market rigging with insider trading like the LIBOR scandal. And then the last part is around financial market intervention. We're looking at the rules of the Bank of England after we review monetary policy in terms of lender of last resort to a government, in terms of regulating the financial markets, and also providing information or forward guidance. Just a very brief reminder that monetary policy in the UK is two of the three parts of monetary policy. So in the UK we use interest rates and quantitative easing to manage aggregate demand. Monetary policy is our main and continual form of doing that. From time to time, 2008, Great Recession, what's going on now, we may need to inject new money into the economy, but also there is the opportunity, which we don't use, but other countries do use, to manipulate the exchange rate, to manage it or to peg it to have an impact on aggregate demand. So this was the monetary policy transmission mechanism, and this showed that if you change the base rate, and the example you had was to increase the base rate, what this will immediately do is increase the market rates in terms of high street banks, and therefore the rates that are accessible by consumers and businesses. Asset prices are the prices of stocks and property, and if there is an increase in interest rates, this will reduce the amount of capital available in the economy to spend on these assets. So asset prices will reduce, expectations and confidence will reduce as consumers and businesses see that there will be less spending in the economy going forwards. There will be less spending on housing, so people's wealth will effectively reduce. If businesses aren't expanding, their incomes will reduce. The increase in the interest rates will increase the demand for pounds, as the relative return on sterling just dollars to pounds there, the relative value of investments in sterling will be greater. So that will strengthen the exchange rate, effectively making imports cheaper and exports relatively more expensive. What this will do is the market rates, so that will increase savings and reduce borrowing as the repayments for borrowing increase and the returns for savings increases. That will reduce domestic demand, so that will be C plus I. The net external demand will reduce as our exports are becoming relatively more expensive. So exports will reduce, but imports in terms of prices will reduce. So as aggregate demand falls at this stage, then domestic inflationary pressures reduce. We've just said that import prices are reducing, therefore the higher interest rates on this side lead to a reduction in inflation on this side. Okay, so quantitative easing or supply of money. After the Great Recession, 2008, over a period of time, the total amount that the Bank of England injected into the economy was 445 billion. 435 billion of this was buying back government bonds and 10 billion was buying back business bonds. So this is the chart here that you have in your workbooks. What this is below it is this version of that, which is the quantitative easing transmission mechanism. So this is similar to what you've just seen with monetary policy for interest rates. This is the quantitative easing. So step one, the bank effectively creates money. So this is the bank just creating new pounds that have never been there before, and then using these pounds to buy bonds back from financial institutions. So over here, this is the Bank of England going to banks, pension funds, businesses, and buying back debt. So a bond is an IOU. A business or a bank gives the government money, and the government promises to give them back that money in 10 or 30 years at a fixed interest rate. So the banks and businesses can't get at that money, but if the Bank of England buys them back, they are giving money back to the bank. So for example, the bank's got 10 billion of government bonds that they were going to get back in 30 years, but now they are going to get it back in 2010. So there's money available. What that does, because they are buying back government bonds, is it increases the price of bonds. So the price of bonds increases, and that puts the asset prices up, and the yield is the relative return on that bond. So the interest that gets paid in relation to the price of the bond. So if the bond becomes more expensive, the yield goes down. This also injects money into the economy. So that's new money, 435 billion of new available finance that wasn't there before. Just in terms of, again, a factor market, so if we think of the supply and demand of money and the price of money being the interest rate, what you have is a reduction in the interest rate. So that increase in supply of pounds and the quantity available of pounds increases, but this also brings down the interest rate in terms of market rates further. So that is, I'm going to put it in green here, cost of borrowing going down. This leads to also an improvement in expectation, so confidence grows, bond prices are rising, more money in the economy. Because the bond prices are rising for the people that own them, so like the pensioners, the pension funds, their wealth increases. So pensioners, people with assets, start to feel a bit more wealthy. just said that the cost of borrowing is coming down, and also because there is an increase in the availability of funds within banks, this increases the willingness and ability of people to get loans. This mechanism then increases spending and income, and this would raise inflation back towards the target and hopefully lead to a boost to the economy from more business and consumer spending. Okay, let's see what happened through a few charts. So as you can see here, what you have is the recession of 2008-9. What the index is showing here is just before the recession. This is the GDP for the economy, so where we were pre-recession. As you can see, there is a significant dip, and the UK doesn't come out of the recession in terms of getting back to the GDP before the recession until about 2014. Canada, start of 2010, the US, back end of 2010, and France and Germany, start of 2011. So it was significant length of a downturn for the UK economy. Japan just beat us as well. Italy doesn't even bear thinking about. So this is kind of looking at, did the quantitative easing, did the interest rates have the impact? So we reduced interest rates all the way to 0.25, and we did that 435 billion injection of money into the economy. And we've just looked at why it should have had an impact on aggregate demand. Now we'll have a look at some of the reasons why it might not have had the desired impact on aggregate demand. And just one other thing to look on at this graph, the yellow box that's just appeared is when the UK were injecting money into the economy over. So that's our period of quantitative easing over that period. So some would argue that it didn't have an impact because of, even at that point, we still weren't back to the pre-recession level in the economy. Looking at the inflation target, so the recession is just at the start there, 2008, 2009, inflation comes below target, and then during that period of low interest rates and quantitative easing, we can see the inflation rate coming up. So maybe some evidence that we have managed to grow the economy in that time, as that's inflationary. What you can see here is the extent to which the Bank of England purchased or used quantitative easing. So in terms of the size of the economy, there's a percentage on the left hand side. You can see that actually our asset purchases when they started in 2009 weren't as large as the US is in relation to its economy. So America went further. That's one evaluative point, that potentially the level of quantitative easing in the UK wasn't enough. And as you can see, kind of after this period, 2014, America starts tailing off its quantitative easing. The reason why, even though our quantitative easing finished around this point, is that the economy stagnates and shrinks a bit, so that the size of it in relation to the economy grows here. That's not more quantitative easing at the end. The ECB has been quantitative easing for a much longer period, and you can see a significant amount of quantitative easing in Japan based around that kind of Abenomics, which is kind of significant amounts of government borrowing to try and re-stimulate their economy. This is one of the arguments. This is one of the arguments around why quantitative easing might not have been effective. So all of that 435 billion plus the 10 billion to businesses went into financial markets. So giving it to the banks, giving it to businesses. Another opposing argument was that a lot of that money didn't find its way back into the economy. So either that the banks used it to pay off their own debt, or secured their finances, or they invested it abroad, so in growing markets, possibly LEDCs. The UK economy was stagnating in that period. Why put your invested money there when you can grow it greater elsewhere? Part of it was that they didn't want the risk to lend to businesses because the risk was still quite high. So one of the arguments was that that didn't get to consumers. It wasn't out there in the economy available for those to lend. And the calculation was that there was an opposing argument, which was just to give that money directly to people. So if we'd taken that quantitative easing and just wrote a cheque to every household in the country, every person would have got £6,834. There would have probably been a very high marginal propensity to consume, because that wouldn't have been income people were banking on. They would have seen that as new income. Some of it would have been saved, but a lot of it would have been spent in the economy, on new cars, on extensions to houses, on durable goods like TVs, washing machines and so on, and that would have significantly stimulated the UK economy. This is another chart from the Bank of England which shows the effect on inequality, so the impact of quantitative easing on lower and higher incomes. On the left hand chart here, this is the impact of it on wealth. So the Bank of England, in terms of assets such as pensions, house prices, the effect of inflation on savings, and also financial asset prices. And what they calculated is that there was about a 50% increase in the net wealth of the lowest incomes in the UK. And then across the income band, people on the highest incomes were about the average. So the wealth only increased by about 20% during that period. You are comparing this with 2007, so just before the financial crisis, to 2012-14. What's interesting is you can see the makeup of people's wealth as well. So on low incomes, a significant proportion of that is to do with the house price. Very few of them have actual pensions, and there's a significant impact of inflation on theirs as well. Very small amount of financial assets. When you get to the higher incomes, pensions is a significant amount, house prices less impact, but they also have a fair chunk of financial assets in that. So one thing from the Bank of England is saying that in terms of progressive or regressive on wealth, quantitative easing was progressive. However, in terms of incomes, so in cash terms, the impacts there were much more regressive. So the least wealthy hardly benefited, the wealthiest benefited significantly. So in monetary terms, rather than as a percentage of people's wealth, you could argue that it has been regressive, and significantly so, that the wealthiest have increased by over £300,000 per person. Okay, one last and quite significant argument against the effectiveness of monetary and fiscal policy is both of them are based on monetary policy specifically, interest rates and quantitative easing are based on the assumption. So there is an assumption that both of these things are used, if it's to boost the economy, to increase borrowing. So both of them, either through just making the cost of borrowing reduce, or the availability of money to increase, that leading to more borrowing by households and businesses, that leading to an expansion of the economy. However, it depends upon the level of debt previously. So what this chart is showing you is, as a percentage of GDP, what's the size of UK debt. So you can see that government debt and household debt and business debt, which is kind of those three there, are each of them 100% of GDP. So UK GDP, something around 2.456 trillion. So the government has about that 2.5 trillion in debt. The UK consumers, households have that in debt, and businesses have that in debt. So we've already got, in terms of our national income, all of it as debt. Financial debt is the financial sector. So that was banks, building societies and so on. So added all together, banks, government, households, businesses, 500% of our GDP as debt. This means that it's quite unlikely that we can take a significant amount of debt on going forwards. This also means that as an economy, our economy isn't based on savings. If you remember the Harrod-Doer model, it's based on debt. So it may be unlikely that we can take on further debt to keep the economy going. So just coming back to that chart, the key evaluative question is whether or not quantitative easing had any impact. And just thinking about it chronologically, the thing that we did first was to reduce interest rates to 0.25. Then we thought, this isn't working, so what we need is 445 billion, 435 government debt, 10 business debt, of money injected into the economy. And by the end of that period, 2012, when we had the quantitative easing, has this had any impact? You could argue no. You could say that looking at the UK, we were stuck, and possibly you could argue that austerity during that period counteracted the quantitative easing. You're injecting money into the economy through the banks, yet taking it out in terms of the government, and that started in 2010. So that might have stagnated the economy. People who argue yes say that the economy could have been worse, so that actually the quantitative easing and the low interest rates prevented us from becoming in Italy, another country with significant government debt. The real answer to that is we'll probably never know. We can't go back and re-experiment with our economy. We can't go back and take the quantitative easing away and see if the economy would turn into an Italy. We can't go back and add even more quantitative easing. If you think of the percentages that the ECB and they did in America, we can't go back and increase quantitative easing and see if that would have improved the economy further. We also can't go back and remove austerity and see if we would look more like America, where Obama didn't go for austerity. He went for expansionary fiscal policy. Okay, what's it for you to do? 3 paragraphs. So you can check the notes that you made around yesterday's lesson. What I'd like you to write up today is 1 paragraph to explain how interest rates boost aggregate demand through an increase in net trade. So don't analyse businesses or consumers in terms of lending. I want to show the impact on trade from the impact on the exchange rate and explain that. Then 1 paragraph to explain how quantitative easing increases business spending. So this would be linked to that buying back of assets and how that money gets its way into the economy. So both of those paragraphs link to aggregate demand. Lastly, just 1 paragraph to explain how either interest rates or quantitative easing would be less effective. So why might they not have boosted the economy to the extent that they could have done, or what might have mitigated or reduced their impact.